Good morning, Roger here. I'm just going to just dive right into this. Jeremy Hunt is about to give his first budget speech in about 20 minutes, so I'm going to just trot through this blog I've been working on, the title of which at the moment is Flou d'Etat Part 2. And Part 1 was the central bank coup d'etat, the central bank balance sheet pandemic. This guy here is John Titus, and this is a video he made on the 14th of February this year, which basically presaged the problems with Silicon Valley Bank and Signature Bank in the United States at the end of last week. HSBC jumped in and bought the UK arm of SVB. But what this video does is ask the question, why is the Federal Reserve provoking a financial crisis? Now, at the end of this blog, I get to a subtitle for this blog. I just scroll up here. I will explain myself in due course. So here we are. The budget is given by the Treasury on behalf of the Kleptocracy, and the Treasury is part of the Kakistocracy. What I'm saying is that the ESG bandits, environmental social governance bandits of the green fascist mafia, that's the new political wing of the Kleptocracy, if you like. And the budget is a looter's manifesto, which is basically austerity for us lot, and land of milk and honey, and picking up for pennies on the pound assets of other people that they've actually worked for, created wealth, and then it basically gets robbed by the financial system that we have. So looking at the budget and expecting it's being delivered on behalf as a sensible looking after of an economy that's run for the benefit of all of us. If you still believe that, you've got some serious waking up to do, I'm afraid. So the Federal Reserve provoking a financial crisis. The Bank of England has basically been doing the same thing. Clearly, the UK and the United States are quite different political bodies, except that they are joined at the hip through the financial system. Now, the UK relies far too heavily on its financial sector, and also way too heavily on its housing market. And these two things are great weaknesses in terms of a spread of risk in the British economy. Now, the US has always, as well as being way bigger, has traditionally had a large, not traditionally, did hang on to its, and still hangs on to its energy sector. They're quite different, but the same. And the where they are very similar is how they revolve around the debt-based dollar. But I'm just going to just go through just a few prompts as we go here. So this was the original blog I did on October the 3rd, 2021, positing a central bank coup d'etat, looking at the central bank balance sheet pandemic. It's all over the world. Central banks' balance sheets just went through the roof. Then this is another John Titus interview on Rich Planet, Larry and Carsten's excellent pandemic, looking at central bank digital currencies. And this guy here, Carsten's, he's a bigwig at the Bank of International Settlements. And this is a record of him basically saying that they want to eat the commercial bank's lunch, or certainly the smaller commercial bank's lunch anyway. Right, December the 9th, 2021, again, same title. And this is links to an interview between Hugh Hendry, who hit the headlines in the 2008 financial crisis, when he basically said, if you're not panicking, he suggests that you do. He's on Newsnight with Jeffrey Sachs, who's a famous economist. Are we headed for a Japanese style lost decade, is what they were talking about there. Right. And then January the 13th, 2022, this article appeared. And it's the central bankers long COVID, an incurable condition. And this talks about the repo spike in 2019. So that ties in with the John Titus video. Introducing that article, I said this is an excellent article and analysis, driving motivation behind the accelerated rush to techno-fascist feudalism has been occupying my mind since the repo spike in 2019. And so these themes are bubbling under before the financial crisis, financial system got into trouble in 2019, and then parallel with the work through of something called going direct, the pandemic came along. There are some people like me that think that the response to the pandemic was not letting a good crisis go to waste. And it doesn't matter whether or not the pandemic was real or not. Subsequently, it turned out it wasn't half as bad as everybody was making out. I think even Bill Gates agrees that that's the case now. So now within all of these big things happening, there are subtexts going on. And one of the subtexts going on is climate change is obviously still this great big thing that everybody should worry about climate change way more than the pandemic or whatever else. And then you get into subjects like peak oil and energy, availability of energy. Now, oil prices peaked before the global financial crisis in 2008, at the same time as you had all the subprime crisis going on. And oil prices also peaked last year, if you remember. That was blamed on the war in Ukraine. Actually, it's more to do with underinvestment. But there are schools of thought about how or what is driving the economy. And one such is surplus energy economics and Tim Morgan's blog. Now, I think Tim's got it wrong. I think that his basic premise that energy return on energy invested are already at the doom laden end of the predictions in the academic literature to do with that. I've challenged Tim on several occasions to say, where's your raw data? Are you using modeling? And are you using stylized data, conjecture? And I've never had a satisfactory answer to that. And I've concluded that indeed it is just a conjecture, which it doesn't pass muster for making policy. Well, of course, the policy in the budget coming up today, the government have been criticised for allowing new oil projects in the North Sea and stuff like that. Is Hunt gonna nail his green colours to the mast for the green mafia? I really don't know. But within this blog, there are links to these sub debates going on. But of course, there are several contributing factors to the general course of the general direction we're going in. Whether anyone's steering it anymore, I seriously doubt. I think that we're in a pretty chaotic situation, but the dominant narratives coming out are through the mouthpieces of the kleptocracy via the Kakistocracy, and so that's what we're here today, the manifesto for the kleptocracy, which is going to be something to do with austerity, so this is from the central bankers long COVID an incurable condition. So this was written by I'm going to open this just to show this. Like I said, I'm going to. So this is on the 18th of October 2021. It is by Professor Fabio Viggi, and he's a professor of critical thinking at Cardiff University. Apparently, he's a speaker at a New Left thing, which CJ Hopkins is also speaking at in London later this month. This is a brilliant article. CJ Hopkins's interviews with called "We Need to Talk About Mr. Global." I haven't seen part 4 yet. I must have a look for it. 3 parts appear elsewhere on this blog. But let's just read this bit here, because I think this gets to the crux of where we're at. So the purpose of the pandemic was to accelerate the pre-existing macro trend of monetary expansion while postponing inflationary damage. Following the Federal Reserve, the world's central bankers have created oceans of liquidity, thus devaluing their currencies to the detriment of populations. While this continues, the transnational turbo capital of the elites keeps expanding in the financial orbit, absorbing those small and medium-sized businesses it has depressed and destroyed. In other words, there is no such thing as a free lunch for us. The central bank's money printer works only for the 0.0001%. That's the billionaire class, with the help of virus or a global threat of equal traction. In the meantime, ordinary people are caught in a suffocating double bind. If credit needs to be made available to businesses, central banks must keep a lid on inflation, which they can do only by draining credit. Runaway inflation can be avoided only by containing the disruptive effects of excessive money creation, that is, by bringing work-based societies to their knees. Most of us end up squashed between price inflation of essential goods and deflationary liquidity drainage via loss of income and erosion of savings. And in a stagnant economy with inflation off the chart, each suppressed business transaction is channeled into financial assets. A tool preventing liquidity from reaching the real economy is the Federal Reserve's overnight reverse repo facility, RRP. While continuing to flood financial markets with freshly printed money, thanks to reverse repos, the Fed mops up any excess of that very cash it pumps into Wall Street, effectively a zero-sum game of give and take. At night, financial operators deposit their excess liquidity with the Federal Reserve, which delivers as collateral the same treasuries and mortgage-backed securities it drains from the market during the day as part of its QE purchases. In August 2021, the Fed's usage of RRP topped $1 trillion, which led to the Federal Open Market Committee to double the RRP limit to 160 billion, starting from 23rd September 2021. Here then is the elephant in the room. How will the Fed's taper square with reverse repos of this astronomical magnitude? Is the much anticipated reduction of monetary stimulus even possible with a global financial bubble fueled by zero interest rate leveraging and structural borrowing? But at the same time, how can central bankers continue to expand their balance sheet when the double whammy of stagnation and rising inflation is just around the corner? Well, that's basically everything that's been going on in a nutshell. On March the 2nd, I did this blog saying mark to market, and that's referring to the tier one reserves held by banks, which were available for sale or to be held for maturity, and the losses thereon. And John Titus analysed that on February the 14th, and prior to this is an old article, Liberty Street Economics from 2015, understanding bank security portfolios, and where are we? Let me just see. I know it's this one here. And then this is John Titus on his February the 14th talk, drew on this Christopher Whalen article from November 28th, entitled "Is JP Morgan Chase Insolvent?" So that's what that is. And here's a quote from there. Banks may face an imbalance between their access to deposit finance or other low-cost funding and their profitable lending opportunities. And then it goes on to explain all of that. Then this was the graph of the FDIC document that came out, and Steph Pomboy said, "I'm puzzling to understand how this is not the only thing that people are talking about." And then this is the mark-to-market business, and this is a old Gollum X1V post. If we just go there, or is it 12:25? I'm going to try and wrap this up in 5 minutes, and then I'll resume after listening to the budget. It's Lexicon mark-to-market. And when did David write this? Usually you can see in the comments. Well, anyway, you can click on that and have a look yourself. So anyway, that kind of brings us to where we are. I'm just going to wrap up for now because I've lost my train of thought anyway. And all this is self-explanatory if you go through it. End of boom and bust, that's Gordon Brown, who then he actually claimed, end of Tory boom and bust. I mean, they all do it. It's and then I go into some Bank of England figures that I'm trying to get the same figures the FDIC produced, but in the UK they're not actually as transparently reported. The Fed don't report them transparently anymore, but the FDIC do. I've been trying to find if the FSA or the Building Societies Association or whatever do. But I'm in the middle of piecing this together, and the only reason I've got Barclays comparing their figures from 21 and 22 is that's the first one that came up. I mean, as far as I know, they're no better or no worse than anyone else. So this is still a work in progress. And then these are some trading economics graphs which show US banks balance sheets and UK bank balance sheets. And in the last year, I was curious to see that the UK banks balance sheets have been declining as the US ones have kind of tapered off and had increased a little bit. They're kind of going in opposite directions, when over a long period of time they've kind of been running up together. And I don't know if that's got something to do with all of this or not. Then from various, this inclusive capital, these are the people I'm calling the kleptocracy. They're basically trying to change the rules and impose a level of entry that excludes everybody else and bring back serfdom, basically. And these people here, these inclusive capital partners, try to make a bid for countryside properties a while back. Countryside, someone was Vistry. I'm not sure if it's even still gone through yet. And then this is the reaction of Danielle DiMartino Booth to the who had retweeted this Steph Pomboy tweet. And then I'm just trying to get to the bottom of what her current take on the market is. And here's where things get interesting. Weakest US companies will have to pay up when junk funding markets reopen after regional banking crisis reprice credit risk. Corporate bond yields, proxy for all-in funding costs, risen. Costs for CCC borrowers, default risks higher. So that's interesting. So with interest rates going up, there is a lot of ongoing consequences from this tightening, these interest rate hikes, so here's the Hargreaves Lansdowne corporate bonds. I mean, Barclays is at 8.69% when I did that, but I mean the links are in this blog to have a look. Right, regulating the shadow of big banking. So that's an interesting Paul Carlier thing. So at the end of this thing, this thing here, that's the Dash for Cash, which is basically looking at the criminality following the global financial crisis. And Paul Carlier knows a lot about that. So that's what that one is there. Right, 12:30. I'm just going to end the broadcast there.